Hello, and welcome to today's Technology Association of Oregon Leadership Exchange, using deferred compensation plans to attract, retain, and incentivize your key executives, sponsored by Bank of America. I am Riley O'Brien, Vice President of Events and Experiences at TAO, and I wanted to provide a couple of logistical things as we get started. All participants have been placed on mute. You'll be asked to respond to questions in the chat box publicly or privately by directing your messages to me. And I'll be monitoring the chat box and respond throughout the session. And you can also use your participant icons to engage with our presenters throughout the event. We ask you to also engage with us on social media during this call and throughout the day. We love to share what's happening at TAO and get participant takeaways from our events. Thank you again to our partner, Bank of America, for sponsoring developing this program for our community. It will also be made available for sharing on TAO's YouTube channel by tomorrow afternoon at the latest. Providing additional incentives using deferred compensation for select executives or key employees helps reward performance and provide a retention benefit as you plan for future growth. We're very delighted to have our experts in the field joining us today to discuss planning and defining clear goals as your company considered adding an NQDC plan to your compensation packages. And it's my pleasure to introduce our host today, who I met in person for the first time a few weeks ago, and our panelists. She's going to introduce our panelists. Vice President and Senior Relationship Manager for Global Commercial Banking at Bank of America, Stephanie Cooner. Stephanie, take it away. The floor is yours.
Thanks, Riley. Good morning and welcome, everyone. I'm Stephanie Cooner, Senior Relationship Manager with the Global Commercial Banking Group at Bank of America. I manage a portfolio of technology clients covering Oregon and Southwest Washington markets. I also have the distinct pleasure of being our liaison with TAO, whom we are especially pleased to support and partner with. If we haven't met yet, I look forward to doing so. I'd like to start off this morning with a story, sort of in line with upcoming March Madness, I suppose. The date is May 14th, 2014, and Steve Kerr has a momentous decision to make. Phil Jackson, his mentor and former Chicago Bulls head coach, where he won 3 NBA championships, is now the GM of the New York Knicks. Jackson is offering Kerr his first head coaching opportunity, but the Golden State Warriors want him too. Kerr is pained by the decision, given his relationship with Jackson, but reflects that Golden State has accumulated some incredible young talent in players such as Seth Curry, Klay Thompson, and Draymond Green. Kerr reaches out to a coaching friend for advice, who asks him, if Phil Jackson were in this situation, what would he do? The answer came as an epiphany. Phil would follow the talent. While loyalty is important, your talent is everything in coaching, Kerr decides. As he later said publicly, without talent, I would have lasted maybe 2 years in New York. 3 NBA championships later, as the Warriors head coach, it's clear he probably made the right decision. So how does this story relate to today's presentation? Talent is indeed everything, whether on the basketball court or in your own business. To both attract and retain talent in today's competitive environment, the depth of employee benefits you provide makes a difference in your employees' loyalty, their job satisfaction, and studies have shown their productivity. Non-qualified deferred compensation plans can be one of the most valuable assets in your company's benefits package. As one of the few providers in the market offering access to a comprehensive array of retirement benefits and financial services, Bank of America understands the role of deferred compensation, not as a standalone program, but as part of an integrated and comprehensive benefits and compensation package. For more than 2 decades, B of A has provided non-qualified deferred compensation plans designed to help organizations and their top-level employees get the most from their benefits today and well into the future. The goal of this morning's panel is to brief you on the high-level issues and points you need to know about non-qualified deferred comp. Our esteemed panelists have extensive hands-on experience working with deferred comp and know how to open these issues. You will learn about the different plan structures and options available, how to design a competitive plan that's right for your company's needs, and how to steer clear of ERISA and IRS pitfalls. Whether you have a plan that needs review or in the process of considering a startup plan, we hope today's discussion will heighten your interest and allow us to have a deeper conversation on this important topic. Our panel moderator is my colleague, Michael Sheridan, Vice President and Senior Financial Advisor with Merrill here in Portland. Michael and his team assist corporate executives of both public and institutionally funded private companies with their wealth management needs and serve those companies with retirement and benefit plans, including non-qualified deferred comp. Michael, without further ado, won't you please get us started?
I sure will. Thank you, Stephanie, for that warm welcome, and good morning, everyone. Why don't I start off with kind of recapping where we are today. While COVID seemingly is on the back burner, the bad news is inflation is running rampant. I saw a statistic this morning that it's at 7.9%. Oil's probably at about $113 a barrel. Russia's trying to start World War III. So while unemployment numbers are good, it depends on your viewpoint. Tech unemployment stands at 1.7% unemployment. So if you're a tech company, you may be desperate for talent. And job candidates seem to hold all the power. So questions like, do you guys offer remote work? Or, hey, what are your vaccine requirements? Those have become a thing. This is why compensation in general and deferred compensation specifically has become such a hot topic. We expect our discussion this morning is going to lead to a lot of questions. So our intent is to wrap everything up at 9:30 this morning. So a number of you might need to leave, and that's fine. If you'd like to stay around, we'll be here and we can keep the conversation going all the way through 10 a.m. For those of you that want to engage with the panel all throughout, we're going to have many opportunities for questions. We've got a bunch of questions that you guys have supplied to us in advance, so we're going to be sure to try to address every one of those. So with that lead in, let me get right to the introduction of our panelists. We have a highly accomplished employee benefits and executive compensation attorney. We've got a senior consultant from the nation's #1 deferred compensation plan record keeper. We've got a certified financial planner with over 30 years of experience on assisting wealth management needs of senior corporate executives for both public and private companies. So first, let me start off by introducing Vince Cacciatoli, who's a principal in Foster Garvey, a Northwest law firm with an East Coast and China presence that has offices in Seattle, Portland, Spokane, New York City, Washington, D.C., and Beijing. Vince has over 30 years of experience in employee benefits and executive compensation and is recognized as an expert in his field. He's listed in the Best Lawyers in America, was named Best Lawyer of the Year for the Employee Benefits ERISA Law in Portland, Oregon for both 2015 and again in 2019. He's also ranked by Chambers and Partners, the International Attorney Rating Service, and its top tier for employee benefits and executive compensation in Oregon. Vince was also inducted as a fellow in the prestigious American College of Employee Benefits Council and is past president of the Western Pension and Benefits Conference. Originally from New York City, Vince received his BA from New York University and his JD from Fordham University School of Law. Welcome, Vince. Next, we have Chris Fernandez, who is a senior consultant for non-qualified plans with the Principal Financial Group. Chris has been working exclusively for executive non-qualified plans and principal for more than 20 years and proactively works with financial advisors and their corporate clients, providing consulting support in design, financing, and administrative alternatives of non-qualified deferred compensation plans. Chris is a graduate of the University of Minnesota. You'll catch a little bit of an accent there, where you're in a Bachelor of Science degree in kinesiology. We don't know what that means, but it sounds very important. Welcome, Chris. Last, we have Graham Newhouse, my colleague at Merrill, who's a Vice President and Wealth Advisor here in Portland. For over 30 years, Graham has been helping senior corporate executives align their financial resources with their goals and has been his firm's corporate equity stock plan liaison with some of Portland's largest publicly traded companies. In addition to being a certified financial planner and a member of the Financial Planning Association, Graham has earned his Certified Equity Professional Level 2 designation and has been a member of the Estate Planning Council of Portland and is the current Portland chapter president of the National Association of Stock Plan Professionals, also known as NASPP or NASP. Graham is a Portland State Viking with a bachelor's degree in economics. Welcome, Graham, and welcome, panel. So of our panel, I want to throw out to you all. One is the founder of a community garden in his neck of the woods. Was a Colorado ski instructor, after college, and one is an avid fisherman who caught an 1,100-pound marlin at one point. So if you can correctly guess by the end of this panel which is which, I've got a bottle of award-winning Pinot Noir from Domaine Serene for you that I'll personally deliver. To get started, though, why don't we start with the question? So this will be a polling question that Riley's going to send out to you. We're very curious about who on the call is either a plan participant or a plan sponsor for a deferred compensation panel. So we'll, or a plan sponsor for a deferred compensation plan. So we look forward to getting some feedback, and I see some of you responding as we speak. So thank you for that. I'm going to start off with Chris Fernandez. Some of this for you as we're seeing the polling come in. Some of it's going to be a refresher, but some is going to be entirely new. Where relevant, we're going to put some slides up. We don't want it to be a presentation. We want it to be a discussion. So, but Chris, let's start with you. Would you give us a brief description of what deferred compensation is and who are the best candidates for this type of solution?
Well, thanks, Michael, and great introduction, and welcome everybody to today's panel discussion. Yeah, great question. When we think about these plans in the marketplace, they're pretty straightforward. They are a contractual obligation between the employer who's sponsoring the plan and the employee who is the participant within the plan. Simply put, it's an obligation that says that as an employee, I'm going to elect to defer some money. That money is deferred on a pre-tax basis. It accumulates on a tax deferred basis, and I pay ordinary income tax on that when it is distributed to me at the Fed state level. Within that, there are a lot of rules with these plans that we'll get into. But in addition to the employees being able to save their own money, we do see a lot where the company has discretion on making contributions to the plan as a way to recruit, retain, reward, or incentivize key people. The other big benefits for employees are that you can save up to 100% of your compensation. Compensation can be base salary, bonus, performance-based comp, long-term incentive award, board fees, commissions. Any type of compensation that an employer offers is an option for deferral into this plan without a cap. So it becomes a very favorable benefit for those highly compensated employees that are either capped on contributions to the 401k plan due to testing, and or if they're making significant enough money where the contribution cap that's indexed each year with the 401k plan simply isn't enough to get them to their retirement goals. The other big benefit of these plans is that unlike a 401k plan where if you try to take distributions prior to a certain age, 59.5 as an example, you're penalized. In this plan, the IRS says that if you want to take money out while you're still employed, you can do that as long as you elect the time of the payment and the form of the payment. Now, there are some eligibility rules. So as you think about, what is a good sort of company to sponsor a plan like this, the eligibility rules are pretty straightforward in that if you're going to offer a plan, you can offer it to no more than 10% of your total employee base. And of that group, they have to be considered highly compensated, making north of 100 to 125,000. Okay. Within that, you have the ability to discriminate and pick and choose who you want to be eligible inside of that plan. So as we think about a plan that or a company that might fit the mold for this, we're looking at companies probably around 100 employees or more, where you have a consolidated group of maybe 5 to 10 people that are highly compensated employees, where they are looking for options to be able to save above and beyond what they can in the 401k plan, and or the company's looking to provide them with a benefit for retention purposes, for recruiting purposes, or just simply to incentivize them. Back to you, Michael.
That's pretty good. That's a pretty good description. Thanks, Chris, for that. How about Vince? Let's go to you, Vince. So you're a highly recognized attorney in this space for employee benefits and executive compensation. What are you seeing as the reasons in today's environment that companies are using deferred compensation?
Well, I call it hitting on the 3 R's, recruiting, retention, rewarding. So as far as recruiting goes, what I'm seeing is that deferred comp is becoming part of an overall compensation package. And these days, particularly, given what the job market is, if you're looking to bring in some highly talented executive talent, particularly at the senior level or the C-suite level, they are looking for not only your salary, of course, and regular bonus program, but they're also looking for short-term incentive, long-term incentive, and deferred comp. And when we're talking about deferred comp is where you're paying, like Chris says, where you're paying benefits out at some point in the future. I may be showing my age, but it's always reminded of the old wimpy character from Popeye, where, I'll gladly pay you Tuesday for a hamburger today, which, work today and we'll pay you at some point in the future. That's all deferred comp comes down to. So, but what the deferred comp plan can do, and there are different ways to structure this. They can just pay out cash, or they can be equity flavored, like phantom stock arrangements or phantom stock appreciation plans, where instead of just paying someone a cash bonus, you are giving them a lot of the financial benefits of being a stock shareholder, without actually creating minority shareholders with all of the problems that creates. I also want to point out the golden handshakes. When you're trying to bring someone in, you can do a couple of things with deferred comp plans. For example, deferred signing bonus. Pay it up front, but you'll only get it at some point in the future. So kind of a retention tool as well. And another key thing, because deferred comp plans are not subject to any IRS or ERISA non-discrimination rules, you can pick and choose who gets benefits and how much. So if someone is losing 401k benefits because they're leaving their firm before they're fully vested, you can pick that up in a deferred comp plan for that. So Michael, we'll get the next slide up here. Okay. So retaining. So how to get people to stay with the firm. You can have creative vesting schedules. Again, you're not subject to IRS or ERISA vesting requirements. So you could do creative things. You're going to have different vesting schedules, for example, for different people. You can give people more vesting credit at the beginning than other people. You can have bad boy forfeiture provisions. You do something wrong and you cancel your benefits, even if you're fully vested. Like non-compete, non-solicitation, violation of company policies, that sort of thing. Some plans even have clawback provisions. If you're getting your benefits based upon financial performance and we find out later that you cooked the books and we paid you out, we're going to get that money back from you. Now, I throw out the caveat about state law issues because some deferred comp plans are subject to state wage and hour laws. It depends on when the benefits are paid out. If they're more like retirement benefits, then you have ERISA preemption of state law. The last point is deferred retention bonuses that if, for example, you want somebody to hang around for a while, let's say you're closing, you're selling the company and you want key executives to hang around through the closing date or maybe even a transition period, you can pay out a bonus based upon how long you need them to stay. Okay, next slide, please. Rewarding. So what I'm seeing is a shift in how deferred comp plans are set up. It used to be deferral only plans. It give the executives the ability to save outside of the 401k plan, or the company would just put in a kicker across the board for everyone, 3% of pay, 5% of pay, something like that. Now we're seeing more performance-oriented programs, more like LTIP type of things, which is performance-oriented, not upfront as far as the grant that you get, but also maybe at the back end in terms of what your payout is, and even performance-based vesting rather than just time-based vesting. Lastly, I also want to point out that deferred comp plans can be a great way to provide a window benefit. You want to do a downsizing or a right sizing, or clear out some of your senior people to let the younger people work their way up in the ranks. You can have the deferred comp plan as having a financial incentive for them. So the 3 R's, that's when you'd use deferred comp plans. Back to you, Michael.
That's good, Vince. Thank you for that. Chris, how about let's give some real world examples. Here we are in COVID. We know that recruiting, certainly for technology companies, is really, really difficult to get talent. What are you seeing in this marketplace? What are some specific examples that you're seeing of how companies are using deferred compensation?
Yeah, thanks, Michael, and thanks, Ben, for the commentary. And I echo what Ben said as far as recruiting, retaining, and rewarding. That has been something significant in the marketplace over the last 24 months. As you can imagine, companies are desperate to keep the right talent around. There's a lot of headhunters out there pulling on the curtails of highly compensated employees to move and shift around in the employment sector, and therefore these plans can be great ways to ground those employees or even to recruit them. But as we think about these deferred compensation plans, and getting back to the initial topic that I brought up as far as deferring your own compensation, this has been prevalent for a long time. However, under 409A, which is the tax code that governs this plan, has a lot of rules and a lot of flexibilities. And from a financial planning perspective, it can be significant, and Graham will get into that in a bit. But as you think about a traditional deferred comp plan that allows for employee deferrals and or company contributions, the idea here is that you can save as much as you'd like into the plan as I described, and you can also determine when you want to take receipt of that. So it creates not only the financial planning tool for saving above and beyond what you can in the 401k plan towards short-term, long-term goals, but it also allows you to kind of play with the tax rates that you'd like to pay in any given year. So a simple example of companies that we work with and how they design their plans allow for employee deferrals of base salary, bonus, et cetera. So here's an example of how this could be taken advantage of by a highly compensated employee that's looking to save some of their compensation with some objectives, right? The objectives being, I'd like to save some money for my education expenses for my child. I'm planning a second home that I'd like to purchase, and I want to really beef up my retirement nest egg. So of my base salary of $250, I'll defer 15% of that, or $37,500, and then my bonus at $60,000, I'll defer 50% of that, or $30,000. So the total deferral that I'm making into the plan for that year is $67,500. As you can see, much greater than what you can contribute to the 401k plan. And with my goals in mind, I can allocate those contributions across these, what we call in-service accounts and retirement accounts. These in-service accounts are paid at defined dates, as I explained. The retirement accounts are paid upon separation. So retirement in a non-qualified deferred compensation arrangement is whenever you leave the company. That could be tomorrow, or it could be 25 years from now. But that is a trigger to start the payment of the benefits that you've accrued, okay? So in this example, I've enrolled into the plan. I've elected to defer the $67,500, and I've allocated percentages of that across these 3 in-service accounts that I've created: 2 for education expenses for my children, 1 for the second home, and I've created 2 defining retirement accounts, retirement 1 and retirement 2, right? Each one of these accounts has its own defined date for payment. So in August of 2023, August of 2025, those when the distributions will happen for my education needs and tuition needs for my children. And you'll notice that the form of the payment is 4 annual installments for Mary's account, 5 annual installments for Michael's. The beach house that I'm thinking about buying, I'm going to just need a lump sum at that time. So in January of 2029, that money is going to come out and be paid to me in a lump sum. You'll also notice that my retirement account, I have 2 of those, and I have different forms of payment, 1 a lump sum and 1 10 payments. The idea here is that when I leave employment with the company, I have plans to potentially, go overseas with my spouse for a little while. Well, wouldn't it be nice to just have a nice distribution from this plan in a lump sum to be able to accommodate that, knowing that the remaining account that I have with that will be paid out over a number of years to support and supplement my retirement goals. The other important feature to know is as we design these plans, we make them look and feel like a 401k plan, in that we offer a menu of funds that the participants can choose between, and they can determine how they want their balances to accrue based on their own personal risk preferences. So as you consider something like this, where you have multiple accounts, you could decide to keep all of these accounts aggregated in one asset allocation, or you could do what we've done here and invest those accounts in different ways based upon timing of when these monies will come out. So something paid in the short term can be more conservatively invested versus something longer term can have more of a risk-based approach. The other component, as you think about this plan, is that, as Vince mentioned, recruiting, retaining, rewarding, those company contributions that the company could put in this plan can also follow suit here. So any discretionary company contributions that could be made typically are made to retirement accounts and are paid at separation. And what we see in the marketplace where these discretionary company contributions happen most exclusively is if an employee is missing out on a match in the 401k plan because of testing constraints. We would normally see that restored here, and a vesting schedule for that match would align with the 401k vesting schedule. Or it could be the company simply matching contributions dollar for dollar in a different way for the specific group that's targeted for this benefit. So as you can see from a financial planning perspective, specifically with regard to employee deferrals, it can create significant advantages for those highly compensated employees. Now, if we flip the page and we start to think about it from a company perspective, Vince made mention of a LTIP. Well, in our world, that's an acronym for long-term incentive plan. And what we've seen a lot in the marketplace is companies have come to us and said, okay, well, we are interested in sharing profitability with a select group of people. We are looking to retain specific people. We are looking to incentivize specific people. How do we do that and lock them in to make sure that we can continue to provide leverage over them, give them specific benefits, but at the same time, put this golden handcuff on them, if you will. The other thing that a lot of companies that we work with are cognizant about is the timing of when those payments happen. So in that previous slide, all of the company contributions that we would normally see to a plan design like that happen when a participant leaves employment with the company. Separation from service, again, tomorrow or 25 years from now, whenever that happens to be. A lot of companies are cognizant and often express that when people vest in their benefits, they'd love to have that benefit be available to the participant. And that's what a long-term incentive plan can do. So in this example, I've identified an employee, and my long-term incentive plan has a 5-year vest and pay design. What that means is that as an award is granted, in this example, in 2022 of $10,000, that will start a 5-year vesting clock. That vesting clock could be graded over 5 years, 20, 40, 60, 80, 100. It could be cliff vest 0, 0, 0, 0, 100. But at the end of the day, if that employee is there at the end of that 5-year period, that 10,000 plus any applicable earnings is payable to the employee. And then next year, if the company decides that they're going to award another grant, in this case, 25,000, that starts its own brand new, unique 5-year clock. So there at the end of the 6th year, that 25 grand plus or minus any earnings is then payable to the employee. So it's a vest and pay design, and it allows the participants to really feel the tangible effects of the benefit coming due. But at the end of the day, the company still reserves that golden handcuff, meaning that if the employee separates from service prior to achieving that vesting schedule, they forfeit the benefit. Okay, so lots of flexibility in how companies do this. And this is an example of a 5-year vest. Best practice in the marketplace, we're seeing anywhere from 4, 5, or 6 years. And again, this can be very significant as you look at how and you'd like to reward and manage cash flow from a compensation perspective.
Very good. Chris, thank you for that. So Graham Newhouse, let's get you into this conversation. So Graham, you and I have a significant experience working with executives, both on their corporate benefit programs, but also on a personal level. And we know that, what they do at home isn't always what they're doing at the office. So how do you do planning with deferred compensation, and how do you tie it in to all the other corporate benefit programs so that these very expensive benefits are being utilized in an optimal way?
Right. So one of the big issues that we see, both even on the plan sponsor side and the participant side, is we hear from plan sponsors that we spend a lot of time and energy trying to attract and retain via our benefits programs. But a lot of times communicating the value of that benefit and the impact it has on the employee's financial success really is difficult. So financial planning really takes the benefit and illustrates for the participant exactly what the benefit is. And any benefit that you offer, if they don't understand the value, it's very difficult for the employee to participate. So when we go through the financial planning process, we're going to go through 3 planning steps, but also show you as we walk through a plan, the things we think about and look at, and then what the impact is on a particular participant. So first and foremost, every participant's unique and has individual financial objectives. So we need to be thoughtful about that process. Not everyone has excess cash flow to defer, but in most cases, if you're looking at deferred compensation, you more often than not do. The second thing is to take an inventory of their benefits, both past and present. They might have 401ks at a previous employer, but we look at salaries, 401ks, equity compensation, which provides a unique planning opportunity, but also if they're going to qualify for any pensions in retirement and what the impact of Social Security might be. And then finally, we look at their compensation and we look at types, tax, and timing. So what types of incomes are they receiving? What are the taxes applied to those incomes? And is there any variation or is there any flexibility on how we can time those? So just to take example, Social Security, we can start that as early as 62 or as late as 70. So there's definitely some flexibility as far as when to start those and what impact that might have in an overall plan. So we look at what the client, or I should say what the participant is trying to do, where they're at, and what's happening currently that provides some planning opportunity. So if we take a look at the tax equation of this and look at some of the opportunities, if you can go to the next slide. So really the beneficiaries are going to be people with high compensations. It might not be high compensation on my part. I might have a spouse that is highly compensated and I can defer my compensation. My personal compensation doesn't have to be extraordinarily high, but a high tax liability in general. It might be a desire to fund future goals. As Chris said, it might be a vacation, it might be college education, or you might have an equity award where you're going to see a windfall in the future that you know you need to offset that by maybe deferring some income in the future. So the first planning benefit is really looking at the tax tables. And the more you make, the more you're going to be taxed. So if there is a way, if you look at the federal tax bracket in the middle of the page, if there's a way to defer some of those incomes that you're receiving at the higher tax bracket into later years where you might be in a lower tax bracket, that's going to be advantageous to the participant. Also, you might look at that income as deferring it from a situation where we're subject to local taxation. So there are 2 new local taxes here in Portland and Multnomah County that are income-based, where you can reduce some of the impact of those taxations as well. So we'll look at a case where we're going to look at how to defer some of this income for someone who's going to go through an early retirement and funding some of those gaps in early retirement, but also coordinate that with Social Security. So looking at that benefit, we're able to defer that to age 70, and any deferral we do beyond the full retirement age, which is 65 to 67, we're going to get an 8% increase in that annual benefit. So let's take a quick look at a case study. Joe and Sally Sample, they're both age 52. They have high incomes, and he receives bonus and annual equity awards. They both maximize their 401k plan, and their current income covers their cash flow needs, so they have excess cash. What they would like to do is retire to age 62. So if we take a very simple approach to this and say, let's see what if we could defer $75,000 of their compensation annually, that will more than likely reduce the marginal income tax rate, but also it's going to reduce their overall tax liability during their peak years. Use that deferral to replace the income gap in retirement. And let's see if we can also try and maximize Social Security. So what we did is we put that into the plan. If we go to the next slide, what you'll see by looking at Social Security first, the bottom left graph, you'll see a gray line. That's the Social Security benefit if they just started at age 62. And it goes up and to the right based on the rate of inflation. The blue line is the postponing of Social Security. So you can see they get no Social Security in the early years of retirement, but once they turn 70, you'll see a large gap to the upside where they're getting much higher income from Social Security for a longer period of time. So that crossover on the right-hand side means that at any age after 78, they're going to be dollars ahead. And over their full lifetime on the bottom left, it's an impact of over $600,000 in payments over their lifetime. So a significant increase in maximizing Social Security. So we went to the next slide and said, okay, if we do make that proposal to defer $75,000 a year, and we do defer Social Security, what's that do for the overall financial success of this particular client? If you look on the bottom left, you'll see if they just retired at 62, didn't defer anything, and just went on their way without any planning, they have a 99% funding ratio, which is great. That's a great plan. But on the right-hand side, if you deployed a deferral strategy with Social Security, their income or their funding ratio goes to 107%. So a meaningful increase in the probability of meeting their financial goals. But more importantly, if we look at the next slide, when we look at the impact of the value of their portfolio, what we call potential wealth, if you look on the upper left-hand side, if they didn't do any planning or any deferrals, their potential wealth at the end of their plan at 90% probability is 4.1 million. And their income, which is the next slide down on the left, at 90% success rate is 152,000. So a successful plan. But if you go to the upper right where it says deferral, if they did the deferral strategy at 90% success, they jump to 5.5 million, which is a just over 1.4 million increase in the value of their worth at the end of the planning time frame. And then, of course, in the bottom right, their income, achievable annual income, is 164,000. So in this case, financial planning really pulls together deferred compensation and a financial plan to really highlight and illustrate what a benefit can mean in your financial success. And that's really what employees would like to see from an employer. They're not there, we don't go to work for fun. We go there because we want to fund the things we want to achieve in life. And if you can illustrate that to an employee how it works, it's much more powerful for the plan participants.
Excellent. Graham, thank you. Thank you for that. Hey, Vince, let's keep on the same theme then of working with executives. On occasion, Graham and I will get called by somebody who has a job offer, and they're looking at us to help them review kind of the matrix of the benefits that they're being offered, whether it's cash bonus, deferred comp, equity compensation, et cetera. If you're an executive, though, what are some of the items that they should be looking at when reviewing or negotiating the terms of their deferred compensation plan, if there is a plan offering?
Well, Mike, the whole topic of negotiating deferred comp packages is pretty complex. So I could hijack the rest of this presentation and barely scratch the surface. But let me point out one key point. What we're talking about here is two sides of the same coin. On one side, you have the executive looking to get special treatment. On the other side, you've got the employer deciding, does this person deserve special treatment? So it comes down to negotiation power. If you're just hiring some middle-level manager, you're not going to bend over backwards. if your CEO is retiring and you found the perfect candidate, you may be bending over quite a bit to accommodate. So, some of the things you look at from the executive's point of view coming into the plan is, where am I going to stand on this? If there's a vesting schedule, can I jump ahead on that? And keep in mind, again, these plans are not subject to the IRS ERISA vesting rules. So you can be flexible and you can have different vesting schedules for different people, and without violating any type of rules. Also, it comes down to, well, how much am I going to get? Let's say it's a phantom stock arrangement. How many units do I get up front? I don't want to be with the herd. I want special treatment. Again, no non-discrimination rules on benefits, so you can accommodate special situations. If you have an LTIP type of an arrangement, as the executive, you would look in and see, okay, what are the performance metrics? Because what I want to make sure is that if I do X, I'll get paid Y dollars, and make sure there aren't any, fuzzy language or weasel words that would let the company back out of paying you 100 cents on the dollar. But again, the ERISA rules don't apply, so there could be forfeiture clawback provisions. So in other words, even if you are fully vested, if you do something the company doesn't like as set out in the plan, or be careful of one, say, in the discretion of the board, you could lose everything. A lot of times executives try to get a rabbi trust. That's a subject in and of itself. But basically what a rabbi trust does is it requires the company to actually stick money into a trust arrangement rather than just have to pay out benefits as a pay-as-you-go basis. Also take a look at change in control benefits. What happens if the company gets sold? What happens to my benefits? When do I get paid? How do I get paid? And tucked away in the boilerplate provisions, things like plan amendment and plan termination. Does the company have full authority to amend the plan? What happens to my payment rights if there's an amendment or a plan termination? Again, because you're not protected by ERISA anti-cutback rules. So you have to look to the exact language of the plan as to how much and whether you'll get paid at all. I've seen some plans that say that the company can revoke this plan at any time. Revoke means take everything back. So you could be going along all fat and happy, think you're cranking out, accruing benefits, and the rug can be pulled out from under you at any point, and you have no say-so and no legal rights. Maybe some kind of come up with some state law contract things, but you don't have a risk on your side. Finally, look at the attorney's fee provision. Some plans don't have one at all. The American rule is everybody pays their own attorney's fees in a dispute. That sounds really great, level playing field, but it really isn't. Your company can afford to pay the legal expenses much more than you can, because what you're doing is I'm now spending my own after-tax dollars to go chase after money that I'm owed in the first place. So kind of be careful about those types of provisions. Like I say, it's tucked away in the boilerplate. A lot of people just, their eyes roll over, they gloss right over it. So just a couple of things to take a look at. Michael?
Vince, thank you. You just scared the hell out of me, but you've given us a lot to think about. Thanks so much. Chris from Principal Financial, let's look at it from the company's perspective then. How are these plans informally financed, and what are some of the considerations that companies should be cognizant of when they're comparing options?
Yeah, great question, Michael. And as you think about these plans, I mentioned that it's a contractual obligation between the company and the employee saying, don't pay me income today, pay it to me down the road. And I also described that, you have the ability to have underlying mutual funds as a crediting option for participants, and they can drive the value of their accounts based on their own personal risk preferences as they see fit. That's typical in the marketplace. But one thing that I haven't touched on is that all of the contributions that have been made to a plan, whether it be the employees deferring it or the company contributing it, all of that represents a liability on the balance sheet of the company. It's a promise to pay. It's an IOU. And with that, companies recognize that if they're going to have this liability on the balance sheet, wouldn't it be nice to set aside some cash as an offset to this liability? And further, most companies would say that we don't want to be in a position where we short ourselves the market. So is there a way that we can invest our dollars in the same way that the participants are being credited on their accounts? Now, as you think about a deferred compensation plan, just remember it's different than a 401k plan. If I put money in a 401k plan, that money is cash in a trust in my name. And as I buy ABC fund or XYZ fund, I'm trading cash, right? This is a non-qualified deferred compensation arrangement. And what that means is that all assets that are segregated for paying benefits into the future are owned at all times by the company, okay? So when we create these plans on our system, we make it look and feel like a 401k plan. To the participant, they go online, they see a dollar value there, they have these underlying funds, they pick and choose between them. We know what those funds would have done in the marketplace, and we can allocate that day-by-day performance and show that to them on their web page. But there's no cash in their accounts. Everything is hypothetical, right? So as companies think about the financing strategy, there's a couple things to keep in mind. One is you don't have to fund the plan at all. You could essentially just create the deferred compensation liability and just pay it out of company cash when the benefits come due. Most companies don't do that. Most companies recognize that if there's an outstanding liability on the balance sheet, we want to make sure that we're offsetting that. So what they'll do is for every dollar of liability that they credit, they'll set aside a dollar of asset. And that leads us to the middle of the page here, corporate-owned taxable investments. Pretty intuitive, right? If Michael is one of the key employees and he has a benefit and he has chosen ABC fund, well, the company can go out and buy ABC fund. Now you have a direct link to the earnings that are being credited to Michael's account. If Michael decides today that he wants to sell off of ABC fund and buy XYZ fund, well, that just means that the company is going to sell off ABC fund and buy XYZ fund to mimic what Michael did and try to keep pace with that on a day-by-day basis. Now, the downside to owning a mutual fund is that there is some additional cash flow cost at the company to satisfy interest, dividends. Those are spun off by the fund managers buying and selling stock inside of that fund. Additionally, if you're selling off fund A to buy fund B, that's going to trigger some short-term gains, which become taxable to the company. And eventually, as you liquidate assets to pay distributions, that's going to trigger long-term gains. So the companies that work with mutual funds have to be understanding that it is a taxable asset and there will be an additional cash flow cost at the corporate level to satisfy the interest and dividends and gains on an annual basis. As a record keeper of these plans, we manage all of that for plan sponsors, and we have to report that back to them in the form of a 1099-R. So who uses taxable investments when you're thinking about financing deferred comp plans? Not-for-profit entities. They're going to do it every time because any gains flow through to a zero taxpayer. If you are an ESOP company, again, a zero taxpayer. If you have operating losses that are carrying forward, you can offset against the gains, so you're not too big of a deal. And sometimes we see companies that put plans in place today, but the plan's going to disappear in 3 years, so they're not too worried about the gain experience that's going to accumulate over time. Companies that are cognizant of that taxation and recognize that they're already paying high taxes, typically S corporations, LLCs, that everything flows through to a personal rate, and or companies that are in Portland, Minnesota, California that pay a high state rate on top of the Fed corporate rate. They're cognizant about that cash flow and looking for an alternative. And that alternative becomes the final bullet here, what's called corporate-owned life insurance. Corporate-owned life insurance is an institutionally priced contract or contracts that are designed specifically to hedge against the taxation. What it allows the company to do is to own those same exact mutual funds as I've described, but inside of an insurance wrapper. And what the insurance asset does, it's the accumulation that's the benefit to the company. All the interest, the dividends, and the gains are able to be compounding tax deferred inside of that insurance wrapper. The company can reach into the cash that's been accumulating in there and pull money out tax-free to then be used to pay distributions to the employees. And the proceeds of the insurance in the event of a premature death of one of the insureds all comes back to the company tax-free, and most companies consider that cost recovery. Now, the downside to owning that type of insurance is that there's an expense to it, right? You have to buy some insurance to get that tax-deferred asset. And in fact, it's the only asset that a company can own to get that tax treatment. So what most companies have to do is compare and contrast the benefits of taxable investments versus the benefits of corporate-owned life insurance, the cash flow costs versus the policy expenses. As we think about companies that would use corporate-owned life insurance, those are the companies that are paying high taxes, looking for an alternative, or they're companies that are looking to have some key person coverage that replicates, an additional benefit to those employees. Because what we see in the marketplace is that the company is the owner and the beneficiary of the insurance. And let's just say Michael is the insured as my key employee. Well, that just means that I own, as a company, key person insurance. What a lot of companies do is they share in the insurance benefit and essentially give Michael free insurance as long as he's employed with the company, which would simply mean that if I had $1 million policy on Michael and there was cash accumulating in it, and if Michael passed prematurely, that $1 million plus whatever the cash comes back to the company tax-free. Well, I might only owe Michael $50,000 out of his deferred compensation plan, but we're going to pay him the 50. But in addition to that, we're going to endorse a portion of that million to Michael's beneficiary. Let's just say it's 50% of that. So we'll pay out an additional $500,000 to Michael's beneficiary, and that would be taxable income to the beneficiary, and it would be fully tax deductible to the company as it goes out. So essentially, Michael has free insurance for his family through the process. The company has key person coverage, and the company has the ability to accumulate an asset on a tax deferred basis. So lots of unique features when you're thinking about financing deferred comp plans, but it really comes down to what's your corporate structure, what's your corporate tax rate, what's the anticipated contributions, and how do we anticipate the rate of return on these assets impacting those gains and interest and dividends or the policy expenses along the way.
Chris, good stuff. Thank you for that. Vince, I want to come back to you because one of the questions that frequently comes up has occurred recently with the changing taxation environment that we're in Oregon in general and in Multnomah County specifically. So Graham referred to the preschool tax and also the homeless tax. So somebody's in the highest tax bracket in the Portland marketplace, they can be paying about 15% of their income to both state and local taxes at a minimum. So that's a big hit. So the question becomes, especially with COVID, where folks can work anywhere. They can work in Beijing or Breckenridge or Beaverton. What about timing and taxability? So let's say you're a retiree, but you made your money while you were in Portland. And now you're retired and you want to live in Miami or Las Vegas or Camas, Washington. How are they going to be taxed?
This is one of those, watch this space for further developments. Because right now it hasn't all been thought through. I mean, both of the taxes, the pre-K and the homeless, are taxed on income derived from employers within Multnomah County or employers within Portland. So there's a withholding requirement. So at some point with the deferred comp that comes out, where was that deferred comp earned? And we're going to get into some pretty technical, convoluted issues about, I'm working from home in Clackamas County, but I'm doing work for a company in Portland. So how much of my work is going to be allocable to the city of Portland, let's say, versus my work from home. It's going to, I think we're going to see some real issues in terms of how do you track the time, and then how is that going to flow through to deferred comp, which is not currently taxable. So again, we have laws that are passed and without a whole lot of thought about the details, because we have people writing laws that have never worked in a payroll department and trying to figure out what they're going to do. So, like I said, keep tuned for further developments.
Got it. Okay. Good feedback for a complicated subject and with lots of gray in it. Certainly not black and white.
Right.
I want to jump ahead a little bit, folks. We've got some good questions that came in from the registrants. So one of the ones that came in was, how do you optimize compensation and deferrals to attract and keep teams? And I'll throw that out for the panel. Feel free, whomever might want to take that one.
I can jump on that one, Michael. So we as a, me personally involved with, thousands of companies every year and what they're trying to accomplish. We always get the question that says, what's meaningful enough compensation to go into a plan like this that is going to be meaningful enough for those employees to recognize that it's a retention type of a benefit. And there's not really a clear answer to give, but we have seen, the way that companies do that. And it's typically a function of a percentage of compensation. And we've seen compensation percentages anywhere from 15% of total comp up to 100% of total comp. It's just whatever the company is budgeting in their mind relative to what they think the value of that contribution would be from a retention perspective. But on average, we probably see it about 25% of total comp is that starting point where people get excited about a benefit like this, and it kind of turns their mind around when they're thinking about looking at an alternative employment arrangement with some other company. The smaller the contributions, obviously it's not as meaningful, but as we think about sort of the way that companies employ people and the dynamics of the various ages that people have within their organization, it's very typical that key employees that are maybe in their late 20s, early 30s, or even early 40s are a little bit more cognizant about cash, right? They're more looking for short-term rewards, right? They're not interested in rewards that are payable, 25 years from now. So it becomes that long-term incentive arrangement that really becomes that attractive component, because the company is telling them, hey, you're going to get this award today, but it's going to be paid to you in 3 years or 4 years. It's tangible to them. They see that it's right in front of them, rather than we're going to make contributions, but you got to stay here till you're age 60 to get it. That doesn't resonate very well. It does if you're more senior, right? And you're not planning on entertaining another opportunity. You just want to make sure that you're getting something special from the company that you've been loyal to, and the company can reward you in that way, targeted towards a certain time frame in which those payments are made, i.e. when I leave employment. So different ways to think about it, but the majority of what we see in the marketplace is dollars based upon a percentage of comp, and then the metric that companies are using to target that could be individual performance, departmental performance, overall profitability. It could be whatever the company employs from a metric.
Michael,
Chris, while we're on that topic, yeah, go ahead, Vince, please.
Yeah, you have time for my 2 cents on this. In terms
Yes,
of
sir.
in terms of the mechanics of the particular question, what do you do to retain a team? Well, it's the question, what's a team? Do you have a definable team, or are you talking about a division? But keep in mind, these plans have great flexibility. So if it's an executive team that may cut across divisions, what you can do is define what would be considered success for that team. And you define the metrics for it. So is it a return on investment, return on equity, sales, sales revenue, net revenue, whatever. And it could be any combination of that. And then what you would do is set a bonus pool, like what we're talking about. If you ring the bells, you'll get 15% of pay, or 20%, something like that. And then you can divide the further, slice and dice, different members of that team could have different bonus goals. And you could further, slice and dice that if you have acceptable performance, you get this. If you hit your target, you get that. If you exceed the target, you get that plus something. So again, it's as creative as you want to be. And I would caution the audience, there's a lot of times that the internet is a great thing, but I've seen people just go online and pull a form of deferred comp. And I've seen a lot of some of the consultants kind of had their canned forms on it. And I'm dealing with one. It's kind of funny because it's got a copyright date for 2012 on it. So, here's something that they use for everybody. It's 10 years out of date. You can do what it is you want. Think about what it is you want to incentivize and over what period of time. You can do these rewards in tranches, a 3-year period, then rolling 3-year periods, rolling 5-year periods. So think about what you want to incentivize over what period of time, and you can change those performance metrics for each tranche. I achieved the goals in the first tranche. Now we're going to recalibrate for the second and do the same for the third, and however many you want. But again, flexibility, because we're not dealing with IRS or ERISA non-discrimination rules. Just by 2 cents.
Got it. No, that's good feedback, Vince. Thank you for that input. We're about to wrap up here, but a very common question that comes up is, wow, these plans sound great. What's the ideal timing to set one up within a calendar year, and how long does it take to set up? This might be best for you, Chris.
Yeah, sure. The plans, if you're looking at a plan for the first time, there's no requirement of when you set it up. You can essentially set up a plan mid-year. What happens then, if it's purely employee deferrals, is you're deferring income that's yet to be earned. So as an example, we're creating plans right now that have effective dates of April 1st, and people are enrolling into the plans in March. They're deferring how much of their base salary or their bonus, et cetera. And that will be affecting payroll, the first full payroll run after April 1st, once the enrollment's wrapped up. And that deferral election will continue and stay in place until 12/31. And then the company will re-enroll everybody sometime in November or December for the full calendar year of 2023. Okay. If you have an existing plan, obviously all those elections are already in place. But if you have people that are deemed newly eligible, you can add them at any time throughout the year. They have 30 days in which to make their elections once they're deemed eligible to participate. So pretty straightforward with regard to implementing a new plan. When you're talking about existing plans, if you're making any changes to those plans, or if people are already enrolled in the plan, you got to make sure that you're drawing a line in the sand with any amendments that are going to take form prospectively post-amendment. And so typically amendments happen, somewhere around 12/31 that are affecting enrollment events for 2023 as an example.
Excellent. Thank you, Chris, for that. Well, folks, in the interest of time, why don't we stop here? We have, for those of you that would like more information, we have a benefits review questionnaire that we'd love to forward to you. It can help us streamline what's important to you and perhaps what documents we might forward on. We certainly hope that you enjoyed today's panel and you learned something valuable. There's probably not a hotter topic right now than recruiting, retaining, and retention talent executives. So thank you again. I'm going to hand the microphone over to Stephanie Kunert for some closing comments. Stephanie, take it away, please.
Thanks so much. I really enjoyed seeing how each of your practices overlap and really provided a multifaceted view into what is a complex space, but one that you have great resources to offer to the market to navigate. Riley, are we going to stick around for some questions after this as well?
There's a couple of questions. Oh, Chris answered it within the chat, it looks like. One question that I had was, how soon, as you're building your company, should you start having these conversations and developing a plan? And so, what stage of company should be looking at this information?
Yeah, that's a good question. Typically we would see, companies that have, some long-term tenure, right? They have good cash flow and they've got a significant group of employees, so you could stay within those eligibility rules, right? The smaller the company, it limits participation, right? So again, getting back to who's a good fit, any company north of 100 is where we would normally see. Can you have plans that for companies less than 100? Absolutely, you can. In fact, you can employ that long-term incentive plan type design across everybody within the company and skirt those employee and those eligibility rules, provided it's not deemed a retirement plan. So there's some exemptions to the rules of eligibility depending upon how you design that type of a plan. But at the end of the day, it becomes a pretty simple process to identify, a candidate for a plan like this, because they have some certain goals. And once those goals are disclosed and you look at the holistics of the company, basically how many employees they have, what's their corporate structure, who are you trying to identify as the benefit, that can really give you some good ideas. I will say one rule of thumb as you think about it is these plans are not designed for owners. And we didn't talk too much about this, but the plan is different than a 401k plan in that contributions to this plan are not deductible for the corporation upfront. They're deductible when the time in which the benefit is paid and those participants recognize the income. So a lot of times we'll have owners come to us and say, hey, we want to participate in a deferred comp plan. Well, if they're an S corporation or an LLC, it just won't work for them. If they're a C corp, in certain situations, if their retaining earnings are large enough, it just adds to the retention of earnings and it could potentially benefit them. But most CPAs would say that it doesn't benefit them to just have money retained in the company when they could just dividend it out and have them just recognize it as income today.
If I could add on to that, a lot of times you'll see deferred comp being used by startup companies or relatively young companies for two reasons. Number one, they need to attract some real talent, but they just don't have the money to pay somebody right now. So there's a question of, if you stick with us and we do well, you'll get a payout at some point in the future, cash. The second time you'll see is with the phantom type of arrangements, where the high tech in particular, where those executives are used to getting stock options, restricted stock, stock appreciation rights. But a small startup may not want to dilute the founder's equity. So you do the next best thing. We're not going to give you stock, but we'll give you these units that perform like our stock. And again, that gives people kind of the financial awards, but it keeps them from being minority shareholders who can claim that their minority shareholders' rights are being violated if the company decides to do this, that, or the other thing. For example, how come you didn't sell out to this particular buyer? It seemed like a good price to us. Those sorts of things you avoid with phantom stock. So it depends on what the needs of the company is. There's no like magic timeline, you're going to be 5 years out, 10 years out, or have a certain size employee force. You can have one person plan. We've done them with one person liquidity event only plans, hiring somebody here to get us shaped up to sell the company. And it's only for that one particular person, and the payoff only comes when the company gets sold. So again, flexibility, flexibility, flexibility.
Certainly in the tech space, we know that no company grows or looks like another. So it's great to hear, Vince, the different ways that non-qualified deferred comp can be applied really strategically to help many types of companies.
I'll just put in a shameless plug for myself. I did an article with for the Portland Business Journal kind of overview of phantom stock plans. If anyone's interested, you just get a hold of Stephanie or Michael and make sure you get a copy.
Well, wonderful. I want to thank everyone so very much for being a part of it today, especially to Bank of America, Stephanie and Michael, to Graham and Chris and Vince for your support of the regional technology industry in a variety of ways, not just being a part of our panel today. We look forward to seeing everyone at future events, either virtually or in person, as we start to open up things here in Oregon. And if you have any questions about this program or anything else, or if our thought leaders today want to send me information that I can distribute out to the group, you're welcome to do that. And this should all be recorded and up on our website by tomorrow afternoon, the latest, probably this afternoon at the latest. But I thank you everybody again for being a part of it this morning, and we look forward to seeing you soon. Take care.
Thanks so much, Riley.
Thank you.